Good afternoon. We're going to get started, so if you are able to get your seat, I am overwhelmed by the turnout, but it says a lot about the importance of this event. If there are people who are unable to find seating, we have teams outside that can direct you to the overflow area. Welcome to Investing in America. The SEC comes to you. My name is Richard Bess, and I am the Regional Director of the Atlanta office. I'm going to do a variation of a disclaimer. When I say the SEC, I'm referring to the Securities and Exchange Commission. Given that we're in the Southeast region, I wanted to make sure that people were not expecting tickets at the end of the event. Thank you for joining us today. And thank you, Dean Hensel, and the wonderful team here at Georgia State University Law School for co-hosting this program with us. We're very excited about this first ever SEC Town Hall featuring the 5 commissioners. It is a testament to the strong commitment that Chairman Clayton and the other commissioners share to our mission of protecting investors, maintaining fair and orderly and efficient markets, and facilitating capital formation. The fact is, one of the best ways to accomplish that mission is to hear from Main Street investors. That's why they're here. During the town hall, each commissioner will discuss an area that is important to investors. After the town hall, each commissioner and other panelists will then participate in smaller sessions that where they will talk with you about key issues impacting Main Street. You can review the breakout session material on the agenda or on the Investing in America webpage to get more information about the individual town breakout sessions. The commissioners are each very highly accomplished, and we've included full bios in their material today, but let me give you a brief description of each of them and what they will talk about. Chairman Jay Clayton was nominated to chair the SEC on January 20, 2017 by President Donald Trump and sworn in on May 4th, 2017. Chairman Clayton has 25 years of experience in the markets as a deal maker and advisor to many of the world's largest companies. Chairman Clayton will talk about choosing a financial professional. Commissioner Michael Pivovar was first appointed to the SEC by President Barack Obama and was sworn in on August 15, 2013. Dr. Pivovar was designated acting chair of the commission by President Donald Trump from January 23, 2017 to May 4, 2017. Commissioner Pivovar is the 3rd economist to serve on the commission. He worked in all branches of government during the financial crisis, and he's a champion of economic analysis. Commissioner Pivovar will talk with us about investing in mutual funds and ETFs. Commissioner Robert Jackson Jr. was appointed by President Donald Trump to the commission and was sworn in on January 11, 2018. Commissioner Jackson brings the analytical rigor of a professor and multidisciplinary skills to the commission. When you look at his writings, they reflect his strong commitment to improving our markets. Commissioner Jackson will talk with us about finding information about the companies you invest in. Commissioner Kara Stein was appointed by President Barack Obama to the commission and was sworn in on August 9, 2013. Commissioner Stein is an architect of Dodd-Frank who, as an aide in the Senate and commissioner, has championed investor protection and managing risk. Commissioner Stein will talk with us about how fintech is changing your options. Commissioner Hester Pierce was appointed by President Donald Trump to the SEC and was sworn in on January 11, 2018. As a professor and in the legislative branch of government, Commissioner Pierce has been a frequent and vigorous analyst of whether our markets are best serving Americans. Commissioner Pierce will talk with us about protecting our information in the digital age. Until now, and now we will hear from the Dean of Georgia State University Law School, Dean Wendy Hensel. I have to tell you that yesterday we talked, and I remarked to her that I was blown away by this building and its technology. We are very, very fortunate to have partnered with Georgia State University Law School. Dean Hensel.
Good afternoon. He wasn't kidding when he said that some people might be confused about the SEC. I was speaking with President Mark Becker of the university today and the Administrative Council, and when I reminded them all that the SEC was in attendance today, our athletic director, Charlie Cobb, perked right up. I had to tell him, I'm sorry, Charlie, that is not what's happening today. It is absolutely my pleasure and a thrill today to welcome you all to the College of Law for this historic event and very exciting town hall with the Securities and Exchange Commission. It is a true honor, and you can tell from the distinguished guests, there's so many of you in the audience today, that if I noted all of you individually, we would not have time to hear what we came for. So I'd like to take just one moment and particularly thank Chairman Jay Clayton, Commissioners Kara Stein, Mike Pivovar, Robert Jackson, Hester Peirce, and of course, Rich Bast, as well as everyone in the SEC who worked very hard to bring this event here today. It means a lot to us that you chose us for this historic event, and we appreciate it. I also believe, I was told that Georgia Secretary of State Brian Kempen is in the audience, and we welcome you here today as well. And finally, to our particularly distinguished guests, those of you who are members of the public, we are extraordinarily happy to have you with us today. We consider here at Georgia State our mission to be a place where important conversations take place and where we discuss the key issues that are facing society and what would fit more clearly into that than the conversation we're going to have today. As Rich mentioned, the SEC's work to protect investors, maintain fair and orderly and efficient markets, and facilitate capital formation is, of course, absolutely critically important to all of us. And that's the same work and passion that's shared by Georgia State University's Investor Advocacy Clinic here, which helps our students. It is run by our faculty and is celebrating its 5th year of existence. Our students, under the guise of faculty, represent real people who have real problems with their broker investors with claims that are under $100,000. And our students also engage very directly in policy conversations about regulations that affect these same investors. We are extraordinarily proud of the work that the clinic does and could not have accomplished that without the support of many of the people in the room here today. The SEC's Investor Advisory Committee, all of the commissioners, and we thank you tremendously for recognizing the importance of our work and for providing funding for what we do. Of course, with all that the SEC does and with all that law clinics do, the work is never done. We are pleased to participate in this event today in the hopes that our investors and those of you in the room never need our assistance and that everything goes as it's supposed to. I hope you all enjoy your time at Georgia State. We're extremely happy to have you here, and once again, welcome to the university. Thank you.
Dean Hensel, thank you so much, and thank you for your hospitality and for gathering this terrific audience. And Richard, thank you for that lovely introduction. I guess you want us to come back to Atlanta. So there were a couple themes that Dean Hensel touched on: education and conversation being two of them. Education here is a two-way street. We're going to talk, each of us, about a topic. We're going to try to keep our remarks fairly short, but we want to hear from you as well. So we'll open it up for some questions, and I'll try to moderate. And if I know my colleagues well, which I think I do, they may even interrupt me along the way with a question or two. The more we hear from you, the more conversations we have, the better we can do our job. So thank you for facilitating that. And with that, I'll jump into the topic that I'm going to talk about, which is choosing a financial professional. And to be clear, I have 4 things that I want to talk about when you choose a financial professional. First and most important thing for a person choosing a financial professional is to ask, is that person registered? Are they registered with the SEC, or are they registered with the state? If they are not a registered financial professional with the SEC or the state, the risks you're taking in dealing with them go up dramatically. They don't have oversight, they don't have inspection, they don't have many of the things that we do and the people we work with at the SEC do day in and day out. I'm not saying there aren't good investments that are offered by people who are not registered. What I am saying is it's much, much, much harder to find them. And if you're looking to get ripped off, it's much, much easier to find that. The second thing I want to say is you need to ask what type of investment professional you're dealing with. People talk about a broker-dealer versus an investment advisor. There are two significant distinctions between them. One is the scope of the relationship. A broker-dealer relationship is a transaction-based relationship. An investment advisor relationship is a portfolio-based relationship. Those are like economic terms. Let me try and say what it means in real words. A broker-dealer is someone you go to and you say, I'm thinking about buying telecom stocks. I'm thinking about a mutual fund that invests in foreign stocks. Can you recommend something to me? An investment advisor is someone you go to and you say, I'm 52 years old. I have a job. I have a 401k. My kids are going off to college. I'd like to save some additional money for my retirement. Help me work through that in light of my needs and my portfolio. So that's the scope of the relationship. Another key aspect of the relationship, how are they paid? A broker-dealer is principally paid by a commission. What does that mean? When you engage in that transaction, when they sell you the stock or sell you the mutual fund, they charge a fee to do that. There may be some other compensation. I'll come back to that. An investment advisor generally charges you a quarterly or annual fee based on the level of assets that they're managing for you or that you manage with them. So one is a commission, a fee based on the size of the transaction, and the other is kind of a flat fee that goes on. Which one is right for you depends on your activity level and what you want from that person. Importantly, understanding the fees, understanding how they're compensated, helps you understand their incentives. I believe that when you understand someone's incentives, you have a much better relationship with them. In short, how are you making money? Now, I talked about the principal ways people make money. There are other ways that both broker-dealers and investment advisors make money. One of the things we're trying to do at the Commission is making sure that an ordinary retail investor who's not 25 years can understand those fees up front. If they can't be presented clearly, they're probably too complex for a retail investor. Okay. Next thing, is the person you're dealing with a person who has some bad history? Have they done something wrong in the past? That's a good indicia that they might do something wrong in the future. It's not perfect. People change sometimes, but you'd like to know. It's information you'd like to know. My recommendation is that you don't engage with a person unless you know whether they have any bad history. This is an area where we've made strides together with our friends at FINRA and the states, but we can do better. And we're working on making our databases of prior bad actions more available to people in an accessible way. This is a wonderful power of the internet. It used to be that if somebody had engaged in a bad act, it was in a file somewhere, at a courthouse, at the SEC, and your ability to get at it, forget it. Now, you can know that. And by the way, I think that deters people from acting improperly in the first place. Last thing, and perhaps the most complicated thing, but it's a question you should ask when you're engaging with an investment professional of any type. And if they can't explain this to you, you need to think twice. How much of my money that I'm giving you is actually going to work for me? So when I give you my $200 a month, when I give you my $500 a month, how much of that money is actually going into an investment that's going to make a return for me? Is it $495? Is it $450? That's a big amount off the top. Or is it, very close to $500? You should know that, and they should be able to explain it to you. I don't think anything that I've said in those 4 steps is very hard for someone who's a professional to be able to explain to you, and you should expect it from them. So that's my advice. It's also how I would ask you to look at an investment advisor. We have tools. I want to make a plug for them. www.investor.gov. Many more questions that you can ask your prospective broker-dealer or investment advisor. Lists of red flags, high-pressure sales tactics. Hey, time is running out. Let me tell you something. I've been doing this a long time. I've never seen a great investment where time was running out. Okay? Let's just so if somebody has one they can, show to me, I'd be happy to be wrong, but so far, not so much. Go to investor.gov, take a look at it. Lastly, when we open it up and with my colleagues, let me know about your experiences. We've had a couple of town halls where we've talked to people about their good and bad experiences. Those are informing our efforts to raise the broker-dealer standard and, most importantly, bring clarity to this space so that, let me just say this, the more clarity we have brought to the investment space, the better off people are. Where we have brought clarity in the past through fee disclosure in the mutual fund industry, people know much more what they're getting into, and through competition, fees have come down. As we bring clarity to this space, people will know more about what they're getting, and they'll get more for their buck, just like they do at Georgia State University. So with that, I'll turn it over to my friend, Commissioner Pivovar.
Yeah, thank you, Chairman Clayton. I want to reiterate the thanks to Dean Hensel for just a very fine welcome. If you remember one thing from what I say, it's what Chairman Clayton's already mentioned, investor.gov, right? If you have any questions on anything, we have a wonderful website. Lori Schock's in the back, the head of our Office of Investor Education and Advocacy. We have a lot of good things online. I'm going to talk a little bit about mutual funds and ETFs, and then, as Chairman Clayton mentioned, we're going to save some time for the end. It's great to be back in the classroom. I'm a former finance professor, so this is very much at home for me. So put away your notes. We're going to have a pop quiz. Just kidding. So I used to teach investments to undergraduates and graduate students, and we talk about the power of what's called portfolio diversification, right? And economists often say there's no such thing as a free lunch with an asterisk except for the power of what's called diversification. And the concept there is that by combining different assets in a portfolio, and portfolio is just a fancy term for a group of things that you put together and invest in, you can end up with a situation where the risk of the portfolio is much less than the risk of a lot or most of the individual assets that are in your portfolio. We spend weeks going through the math on this. It's a great way to test students on whether they're paying attention, but it basically comes down to the old adage, don't put all your eggs in one basket. Right? Don't invest all your money in one company, because if that company goes bankrupt, you lose all your money. So how do you diversify away that risk? Well, you start investing in a second company. Well, but there's still the risk there that that either of those two companies could go broke, or maybe they're in the same sector, so you're still facing some of the sector risk of, let's say, they're consumer companies or .com companies or whatever it is. And what you can do is to diversify away that risk, just start adding more and more assets to your portfolio. And as long as the companies are not perfectly correlated with each other, you get this power of diversification. And you can do it one of two ways, basically. One is you can go out and you can buy all these individual stocks yourself. And you can go through a broker, an investment advisor, and you can do that and put all these things into your portfolio, and you're going to pay different transactions costs for doing all these things. A simpler, more efficient, more effective way to do it that works for many investors is investing in mutual funds. Right? And what a mutual fund is a company that pools together money from lots of investors, and they diversify, they take the money and invest in a bunch of different companies. Right? And we, the SEC, have been regulating mutual funds since 1940. And we have a lot of investor protections on mutual funds. For example, in the diversification piece of that, we have concentration limits. So mutual funds are not allowed to concentrate in a small number of companies. They have to be diversified. If you call yourself an equity fund or a stock fund, you have to primarily invest in stocks of company, which represents ownership in that company. If you call yourself a bond fund, you have to invest mostly in bonds of companies, which are essentially you're making loans to those companies and they're paying you back with interest. Or if you call yourself a money market fund, you have to be primarily invested in a bunch of money market, very short-term type instruments. And so mutual funds are a way for individuals to get diversification very, very quickly. I mentioned they're companies. And what the companies do is they offer to buy and sell or exchange and redeem your shares. You can do it directly through a mutual fund company, or you can go through a broker or through an investment advisor. In addition to diversification, the other thing that mutual fund companies offer investors is professional management. They will keep track of all the what's called the net asset values of everything in the portfolio. So the shares of the mutual fund you transact at, it's basically a weighted average of everything that's in the fund minus some fees that they charge you for administering the fund. And most mutual funds, the fees have come way down in the last 10 and 20 years due to competition. But that's probably the biggest difference, or probably the biggest thing that investors need to take into account is what are the fees and expenses that the funds are charging you. Now, there's all kinds of different assets that they can invest in. I mentioned stock funds and bond funds and money market funds. There are things that are called blended funds, which could be a mix of stocks and bonds. They can invest in international securities. They can invest in all different types of things. And mutual fund companies offer a menu of choices that will fit your needs, whether you want to buy directly from them or whether you want to go through an investment professional and try to figure out which ones are the best for you. In another dimension, one way to cut the difference between mutual funds is broad categories of what's called active versus passive management. So passive management is a fund that tracks an index and doesn't try to quote unquote beat the market. All they're trying to do, they call themselves, let's say, an S&P 500 index fund or a Wilshire 3000 index fund, and what they're trying to do is broadly match the indexes that have broad appeal to investors. And for many people, that's a very attractive one because you say, well, I don't know how to beat the market. I don't know how to pick the securities that are better than any others in a particular industry, so why don't I just own a little bit of everything, right? Or I don't know how to pick the manager who's going to be able to do that. Other people say, well, there are some managers out there that have pretty good track records or have a pretty good way of thinking about trying to beat the market. They're going to be able to pick the particular securities and particular industries that can hopefully beat the market. And there are passive funds and there are active funds out there that are available. In general, the active funds tend to have a little bit higher fees because the management is doing a lot more for you. What's important when comparing funds is to look at the performance after the fees. So for example, if you have an actively managed fund that beats some sort of market index by 1%, but they're charging you 3%, you've just lost 2% compared to if you would have just invested in an index fund. But if they beat the market by 3% and they only charge you 1%, then you get an extra 2% annual return. One of the key concepts that we also teach in finance is the power of compounding. So start saving earlier, $1 today invested gives a return, and then you start earning money on the money that you've already got a return on, and you get the power of compounding goes way, way up. That's the benefit of investing early. The other thing to think about is fees compound as well. So anytime you're paying someone a fee, that's money that's taken out of your account that would otherwise be compounding over the next 10, 20 years, whatever it is. So be very, very careful about looking at the fees, particularly with index funds, because index funds are basically commodity products. They're all trying to get the same index. There's a little bit of tracking error, but the basic difference there is fees, and they're offering the same exact product, right? So that's a couple things to think about for mutual funds. The other thing that mutual funds offer is daily liquidity. You can buy and sell on a daily basis, either directly from the fund or through a broker, and you just get whatever the values of those securities are on that particular day. They're also fairly affordable. I mentioned the fees, but competition has been bringing those fees down, and we have a lot of disclosure requirements. You can find a lot of stuff on investor.gov, or you can look at the shareholder reports, the prospectuses of mutual funds, and get very, very good information about the fees that are out there. A similar product that's gotten very, very popular in the last few years are exchange-traded funds. And they're a type of open-end fund, similar to a mutual fund, but they offer liquidity throughout the trading day. So rather than buying exchange-traded funds from a mutual fund company, you end up buying and selling them on an exchange. And there's a whole framework behind that in terms of how that works. There's a whole group of people that are called authorized participants and market makers that keep the prices in line for those exchange-traded funds into about what they are for the weighted average of all those securities that are held in there. There's some slight deviations during the day, but most of the time it's very, very close. And these are very good options for people who want intraday liquidity for these funds. It's also the fees on these tend to be very, very low and are actually competing with mutual funds, and so can be potentially a good investment for folks either combined with mutual funds in your portfolio, or maybe even or moving over from mutual funds to exchange-traded funds. One thing I do want to mention with exchange-traded funds is there's a particular type of exchange-traded fund that's out there that's called a leveraged exchange-traded fund, or an inverse exchange-traded fund. And what these funds do is use leverage, use debt to magnify the returns. And so there's what's called 1x and 2x and 3x funds, or minus 1x, minus 2x, minus 3x. What does that mean? It means they're using leverage so that if you get one of these leveraged index funds that's tracking a particular index during the day, and if that index goes up 1%, maybe these things go up 2% or 3%. So they can magnify the returns on the way up, but they can also magnify the returns on the way down. So they can be particularly risky on that, but are potentially very good investments for people who need intraday hedging strategies, more for sophisticated investors. Inverse funds basically track an index, but when the index goes up, it goes down, and it's a way for people to short the market, those types of things. Very appropriate products for trading during the day. The reason why I mention it here is for the vast majority of individuals that hold securities over not just days, but weeks and months and years, these are most likely not appropriate products to hold over the course of multiple days. The reason why is because these things are specifically structured so that at the end of every day, this leverage gets reset. It's complicated, but the fact remains that if you're holding these things over multiple days or months, it's not giving you what you think it's going to give you in terms of tracking the index, and it's potentially not a suitable investment for holding over the days. They're very suitable for intraday stuff, but we've been doing a lot looking with exams and enforcement actions, looking at brokers and registered investment advisors who are recommending these things that are not suitable or not in the customer's best interest. So I just put that caution out there for you on those. But the vast majority of ETF mutual fund products are a very, very cost-effective way for people to get the only free lunch in financial markets, which is the power of diversification. Thanks.
Thank you very much. We're now going to Commissioner Jackson.
Well, thank you, Chairman Clayton, and just want to reiterate my comments. My colleagues, thanks for your very warm welcome to the Dean, to Richard Best, and to everybody who put so much into this event. I'm thrilled to be here, and I think this is something, and I know we all agree, this is something the Commission needs to do, should do, and must do, which is find out what investors are thinking, what's going on in the markets, and how best we can help American investors use our markets in the most effective way possible. I'm going to just back up a moment and try and briefly say a little bit about why all of us are here, and I hope why many of you are here, which is that investing has the ability to change individuals' lives, to take your family from one place and one plan to another one, or to help you achieve a new career or a new goal. And I know everybody here at the university knows that investments in things like education can so often change one's life. And the reason we're all here is because we want to, I think, tell you a little bit about the tools that are available to you to help you do that, and take advantage of the possibility of changing your lives. You know, for me, investing was the difference between the honor of being here and a very different life. You know, I was born to two parents in the Bronx in New York. My mom is one of 9. My father's one of 5. I have 97 first cousins. They're all here today. You can see, yeah. And the only reason I'm sitting here, honestly, is because my mother and father believed that if they put a little money away each week, they might someday, maybe I'd get to go to college. That was the upside. And I'm sitting here because they believed that if you took Commissioner Pivovar's advice and if you diversified and worked hard and put some money away, you could change your son's life, and that's how I ended up here. And what I want to say, if you remember anything from what I'll say, and I'll be brief, I know we're a little bit behind, is just remember that however important that mission is to you, whatever it is you're trying to achieve, ask questions when you put your money to work that reflect how important that mission is to you. Because if your family's future is at stake, if the path of where your kids are going to go to school or where you're going to retire or what your next career is going to be, if that's what's at stake, you should ask questions that reflect those are the stakes of the game for you. And I want to echo my colleagues who pointed out that whatever area you're interested in, you can find out more, and you're entitled to know more about the choices that you're making. So the chairman pointed out that if you're going to engage with a particular type of financial advisor, there's a website, it's called BrokerCheck, where you can go online and find out about that advisor's history. And you ought to ask that question of yourself and your family: is this the person we want to trust with our financial futures? As Commissioner Pivovar pointed out, I thought very, very helpfully, you can go online and find out, this fund says that we can beat the market or that we're going to try and track a particular market. Find out what market that is and why, and whether that's the one that meets your goals and your family's needs when you're making investments. The topic I'm going to talk a little bit about is the questions you can ask of the companies that you might invest in. And I guess I want to emphasize for you that, and here I'm just really borrowing from the chair's remarks, if you're investing in a particular company, if I were you, the one question I would want answered, especially if my family and my future's at stake, is how does that company make money? What's your business? How do you actually convince consumers, or whatever your market is, to come to you, and how do you turn that into profit? And I'll tell you, the federal securities laws and the work of my colleagues at the SEC gives you lots of ways to find out the answer to that question. As Commissioner Pivovar pointed out, you can go on investor.gov and get some information. You can go to our website and get filings that companies are required to make, and they'll have to tell you how they make money. You know, it's a funny thing. We talked a lot about a lot of technical terms here, but one of the nice things about the securities laws is that they tend to sort of lay out for you the answers to questions you have if only you know the right place to look. So if you go onto our website, or what's known as the EDGAR system, where you can get companies' filings, you can get a company's annual report. It's called the 10K. And my favorite item in a 10K was always item 1 of the 10K. When I used to teach securities law, I would tell my students about this. Item 1 is called business. What's your business? And it's a funny thing, because for all the fancy securities lawyering that you hear about, a lot of people don't even read this. And if I were you, if my family's future were at stake and I was picking a particular company to invest in, I'd be looking at item 1. How does this company make money? What's its plan for the future? Is its plan for the future aligned with my plan for the future? Or, as Commissioner Pivovar points out, might it make more sense for me to be more diversified? Rather than betting on this particular company or this particular business plan, maybe I should diversify across potential options. There are many other places where you can go online to figure out what's happening in the companies you're investing in. Every year, most public companies will file what's called a proxy statement, where they'll have an election for the board of directors. That statement will disclose all kinds of things about the company. Just to build on something that the chairman raised, if you're going to invest in a company, you might want to know, what are the incentives of the folks who run it? How do they get paid? What are their incentives? What are the targets they're aiming for when they run the company? Proxy disclosures can tell you a little bit about that. You might be interested in knowing the guys who run the company. Do they own the same kind of shares I do? Are they buying or selling shares? You can find that online, again, going through investor.gov or Edgar, on what's known as Form 4. Every time the manager of a public company buys or sells the company's stock, within 48 hours, they have to tell the world whether they're buying or selling. Whether you want to know about those questions or whether you prefer the kind of financial advisor that my colleagues have talked about or the kind of fund that Commissioner Pivovar described, here's the message I want to leave you with, which is if you're putting your money at work this way, if you're putting your future in the hands of one of these companies, ask questions that reflect the importance of that mission to you, because you're entitled to the information that's out there for you to have. So again, thank you so much to the Dean for this very warm welcome. Delighted to be here. Look forward to taking some of your questions.
Thank you very much. Commissioner Stein.
Thank you, Chairman Clayton. I also want to thank the law school for hosting us today. I'm going to talk about fintech and how it's changing your options. And we're going to have this afternoon a more detailed panel on Bitcoin and ICOs, which is in the news almost every single day right now. It's no surprise to any of us, the world is changing, and I want to talk in particular about how technology, in particular financial technology, is changing the investing landscape. For most of the Securities and Exchange Commission was created after the Great Depression in 1934, so we've been around for 80 years. And for most of that 80 years, we're filled with lawyers and accountants, and we're very focused on paper and documents. But over the last decade or so, we're increasingly needing to focus on data. So it used to be, we're talking about all these filings that get filed with us. Now we're having these things filed with us electronically. And I know most of you are getting a lot of your data through email, text messages, and different types of data crunching applications. So we have more and more data available to us on the internet. I had an interesting statistic that 90% of the data in the world has been generated over the past 2 years. So each of us is not only consuming more data, but we're also producing more, and the pace is accelerating. Financial technology, or fintech, is a way to help us deal with all of that data and to transition into the digital age. So there's incredible promise with some of the cool things that are happening in fintech. And I think it means changing what's possible, both from a capital raising standpoint to an investing standpoint, and from our perspective, an investor protection standpoint. It has a potential to reduce the cost of investing. It could decrease the cost of capital allocation. And I think clearly we're challenged, we're being disrupted, just like everybody else is, in how to embrace the innovation and make sure that it's used effectively. And one of the things we are starting to try to think through is how to be prepared to anticipate and ideally prevent problems before they arise. And I think remaining competitive requires both us as regulators and market participants to thoughtfully evolve with the innovation and not react to it after the fact. For example, there are increased risk for pump and dump schemes or Ponzi schemes, perhaps, because it's so easy to now invest in that hotel resort community in some African nation, right? All across the capital markets, technology and innovation are actively challenging not just the old ways of transacting business, but also the old ways of thinking about regulation. We are starting to use new data tools. Typically when we see a problem or it looks like somebody's ripping off an investor, we sort of did old school investigation of the case. Now we're using custom data analytics to sort of see where there might be outliers in a particular area. And it helps us hone in on who we're going to be looking at. We're all involved in creating something called the Consolidated Audit Trail, or CAT. That's going to allow us to provide better market surveillance of our stock markets. So again, I'm just making the point, data and technology are presenting us with tremendous opportunities for benefits, but they're also opening the door to some new and exceedingly complicated risk. And I think all of us need to be less paper-centered and more data-centered. And we've even been talking at the commission, I think of data sometimes as the new library, but we're being overwhelmed and flooded with the data. So how do we change how we're collecting our own data, how we're storing our data, and how we're using it? Of course, with increased use of technology, also there is an increased cyber risk, something that many of us have unfortunately been aware of. And the other part of this is that computerized marketplaces are inherently interconnected. So we have computers interacting all over the world on a trading day, so a problem in Hong Kong can come immediately, to the United States and vice versa. So we have to think about how we coordinate solutions to stresses or problems in our marketplaces. We have new things like robo-advisors, online peer-to-peer lending, equity crowdfunding, and blockchain technology. So those are examples of new and disruptive technologies in our market. And the financial industry is savvy in using some of these new technologies, is rapidly evolving, and we are trying to keep pace. All of our offices and divisions are focused on it, and truly all of these things affect our mission. We all want to foster innovation, but it can't come at the cost of lax investor protection or loss of market integrity. Our markets, I think, are built not just for investors, but also for the companies who are trying to access capital from the marketplace. Those basics aren't going to change. And the market is naturally evolving to accommodate new products and new ways of communicating. But at the end of the day, we have to ensure that the markets are reliable, they're trustworthy, they're fair, and competitive. I'm going to mention blockchain technology has been getting a lot of attention lately, and it certainly is underlying some of the important fintech innovations. And as we all look at these innovations, we need to constantly question, can it be used to enhance the quality of our markets and investor protection? Or the flip side of that, is there a way it could be used to monopolize markets or undermine competition? How should any technology be best deployed? Should it run via public-private partnership, for example, like the internet? If the market begins to move towards blockchain technology, I think regulators do need to be in a position to lead, harnessing its benefits and responding quickly to potential weaknesses. So I'm going to end on a few questions to throw out to you, and maybe can answer them after Commissioner Peirce speaks. How are you finding your investment options? What information are you using to make your investment decisions? What technologies are you using for making investment decisions? What information do you find most reliable or relevant for making those decisions? Do you rely on third parties, like a broker-dealer, an investment advisor, or some type of other platform? But the big question is, how is technology impacting the way you invest? How are you using it? And what's the most important thing we could be doing as a commission to help in this area? So I look forward to your questions, and I'll turn it over to Commissioner Peirce.
Thanks, Commissioner Stein, and thank you to the law school. Thank you, Dean. Thank you to all of you for being here today. It's really a pleasure to be able to be outside Washington, D.C. and hear from you all what's important to you. And I think the questions that Commissioner Stein laid out are a great start for our discussion. So I'm just going to start with a little story, and the story is that a few years ago I decided that I would send a friend's kids some candy because I knew that they didn't get any from their parents, so I like to be the bad influence from the outside. So I sent a big package of candy. I get a call from my friend saying, Hester, thanks for the candy. The kids love it, but what was on the flash drive? I put it in my computer and there was nothing on it. And I said, flash drive? There was no flash drive in that package. And she said, well, it did look like the package had maybe been opened. And so I said, send me a picture of the flash drive. And she sent me a picture of it. And I had never seen this flash drive in my life. You know, it wasn't that I had accidentally knocked it off my desk into the package. So bottom line is that probably that flash drive was put in there on purpose and had a virus on it. And I think what this story illustrates is that people are very clever in the ways they try to get at your personal information, and you have to be vigilant. And it's you know, even when you are vigilant, you can get into trouble. And so I think some of the things that my colleagues have spoken about today suggest that we have more options than ever. We have more ways than ever to be involved in investing, to learn about investing, to ask the questions that we need to ask before we invest. And that's wonderful. And technology has opened doors to all of us that we should be very grateful for. But at the same time, it brings new risks. I think Commissioner Stein touched on that. And we have to be aware of those risks. So I'm going to point you to a place that you've already been pointed to today, which is investor.gov, which will give you some ideas about how to protect yourself as you're investing in an online world. And also we'll recommend to you that the Federal Trade Commission, ftc.gov, has some tips on how you can protect your personal information, and it's worth checking that out as well. So as individual investors, we have to ask lots of questions. We also have to take measures to protect ourselves. Companies also are facing increasing cybersecurity threats. And so we, as the SEC, part of what we try to get companies to think about is how they should respond when they run into problems in the cybersecurity world. So we just put out some guidance recently for companies, trying to help them think through how they might disclose that to you, because as an investor, you probably want to know if there's been a big cyber attack on a company in which you're invested. So we also, as an agency, any government agency is vulnerable to cyber attack, and we've had our own problems. We have a filing system, which you've heard mentioned here today, EDGAR, it's called, and we had a little problem with EDGAR being attacked, probably a big problem. And the good thing is that we have a chairman who has taken that problem head on and is really working to shore up our own defenses. So I think we're telling you to be careful, but we're also taking our own medicine, and we're looking at ways that we can better protect the information that we have as an agency. And so I urge you all, I'm going to keep my remarks very short because I know we're short on time, but I urge you all to just think about, as you get more involved in investing through online fora, think about how you can protect yourself, and we're going to be doing the same thing at the Commission. So thank you very much, and I think we can take some questions now.
Thank you, Commissioner Peirce. I hope you got a flavor, and I'm going to open it up quickly, for how we think about our jobs in the areas we spoke about. But look, let's hear from you. Reactions to our comments, questions. Let's fire away, please.
Yes. Do you think the SEC has any institutional responsibility for the magnitude of the Madoff fraud and impact on investors?
Let me repeat the question. Question was, do you think that the SEC has institutional responsibility for the Madoff fraud and the adverse impact on investors' lives ruined? I'm happy to take this on. Let me tell you this. I know that Ponzi scheme, it's a Ponzi scheme. That's what it was. It was taking in new money, paying off old people to keep the game going. That type of scheme is at the forefront of our minds. Whether it's institutional responsibility or, I think more importantly, institutional memory, it's with us every day. Our people who inspect in our inspections division, think about it. We go through a number of exercises to ensure that type of thing can't happen again, including asset verification and using data, as mentioned by Commissioner Stein, to say, hey, does this stuff add up? Because there, it didn't add up. I don't know if any of my other colleagues want to say anything. Go ahead.
Yeah, just a couple words. On the back end of the Madoff scandal, the commission went through a soul-searching process and said, all right, what went wrong? Why did it take so long to find this? And there's been a number of things that the commission has done to make sure that something like that doesn't happen again in terms of that magnitude. One I will mention is we've centralized what's called our tips, complaints, and referral service. So anybody out there who thinks that there's any type of ongoing fraud out there, please give us a tip, a complaint, a referral, whatever it is. And we've centralized that because we know that any one single tip may not be useful, but if you get multiple tips or multiple questions, a pattern of that is very, very useful and has proven already useful in stopping frauds before they get as large as the Madoff. The other thing is, one of the things we have now is what's called the whistleblower provision in Dodd-Frank. Now, if anybody gives us a tip that leads to a successful enforcement action under certain conditions where we get monetary penalties, the person who gives us that tip can get anywhere between 10 and 30% of the money that we get back on behalf of investors. So it's encouraging people to come forward more quickly on those things. So we've done a number of things to try to mitigate that. Commissioner Peirce, did you want to?
Yeah, I just want to reiterate that I think Madoff is something that, as the chairman said, we think about all the time, and we are constantly thinking about how we can better run the agency to avoid things like that from happening and to stop them earlier in the process. You know, people will always try to do bad things, right? But we have taken a lot of lessons from that event and from the Stanford fraud as well, and are trying to work on addressing problems before they arise to that magnitude, grow to that magnitude.
So I'm gonna move on to a new question. I will say that my breakout session is on stopping fraud, and I'm happy to talk for the entire breakout session about different types of fraud and what we're doing to stop them. Way in the back.
My name is Abraham with the Blockchain Chamber of Commerce, and my question to you is, does the SEC have any official position as it relates to blockchain technologies? Because right now, without a lot of clear guidance, a lot of great blockchain technologies are moving overseas. How can we keep those technologies here in the U.S.?
Okay, we're going to have a breakout session on that as well, because I know it's a hot topic, but let me try and be quick. Blockchain technology has incredible promise for the securities and other industries. I think we can all agree on that. The cost, what blockchain technology does, among other things, but what's at the fore of my mind, is that it greatly reduces transactions costs, including the costs of verification. It's powerful technology. That technology people have used to apply to fundraising. Fundraising is older than the commission. But since the commission has been in existence, we've had pretty clear, I'll say very clear, but I've lived it for a long time, rules on how to conduct fundraising when you're offering securities. Much of what I have seen in the quote ICO or token or ICO space is a securities offering. It is raising money for a project where I give you my money, you give me some type of right back that reflects a return on your project. That's a securities offering. And I don't know how much more clear I can be about it. There are two ways to do a securities offering. You can do a private placement, or you can do a public offering. We've built a $19 trillion economy, an economy that's the envy of the world, equity capital markets that are the envy of the world, following those rules. I expect people to follow them. Sir.
The investor education focus has typically been on the individual investor for a good reason and good cause. I was asking, my question is, have you given thought to some requirements for institutional investors by way of public pension plan trustees? Many times are lay people, but they are fiduciaries, in fact, for billions and trillions of dollars that are out there in the marketplace, and they're subjected to making decisions with some very sophisticated asset managers.
Let me repeat the question, just so everybody can hear. Great question, and then maybe one. So, lots of money in public pension funds. People who are charged with investing that money, do they have the tools necessary and the education necessary to invest that money properly? Sir, thank you. Yeah, no.
It sounds like it's going to be me. I'm happy to answer it. I think it is part of our mission to protect all investors, and in particular, people who would be trustees helping, retail investors, right, effectively. So I think one of the things you need to tell us today is how we can help you get the tools that you need to be the best trustee possible. So I think that's, again, when we talk about investor.gov and some of our investor advocate, some of the ways that we've been trying to reach out and be there for you, how can we do a better job?
Look, I just think I want to recognize, I agree with Commissioner Stein. Important space, very important space.
Thank you. I run a registered investment advisory firm in South Carolina, and I've been researching forward contracts specifically. They're generally unregulated private party contract dealings. What are the limitations on issuing, brokering, and transacting in those before there would be some required regulation or registration of those types of contracts?
Okay. Look, I'm not sure about the specific product. I'm gonna turn your question back to something that Commissioner Pivovar was speaking about, and that is a complex product, a product that, hey, I'm offering you this, and there might be a return in the future if a certain event happens, but if the event doesn't happen, you get no return. People call those binary options. Like, hey, if the Eagles win the Super Bowl, I get money. If they don't, I don't. Products.
That's hypothetical, though, right?
I'm still so happy. I can't tell you. I'm sorry. But
He's from Philly.
But what I want to say about that type of product and retail investors is if someone can't explain it to you, like Commissioner Pivovar explained about leveraged ETFs, and that this is a product that really only makes sense for a very short period of time, don't invest in it. I don't know.
I'm going to go even further. If you're spending as much time as you are trying to understand that product as an investment advisor, maybe you should not be engaged in it. Like, one of the lessons for me from the financial crisis is everybody came in to tell us about the wonderful financial products that they had available, and they were diversifying risk all over the world, and you could put all of these bad mortgages in one pool and it would just work out great. Was, if you can't understand it, maybe there is something a little bit wrong with it. So think about that too.
But I'm happy to catch you afterward on your technical question. All right, let's go right way in the back there. Yep, yes.
My question is, should we, as my 401k investors, have any concerns? I know for me personally, I rarely make any changes to my 401k account, and I just didn't know if there's something we should, that investors in 401ks should know.
Would you like to take that?
Sure,
one,
yeah,
Commissioner Jackson?
it's a very important question, and again, just to make sure everyone heard it, the question is, I don't make a lot of changes often to my 401k account. Is that okay? So first, yes. I think if you make the decision that you're comfortable with your investments and you're comfortable with those over the long run, I think that's just fine. But what I would urge you to do is ask yourself that question on an ongoing basis. That is, when you get that statement, take a good look and ask yourself, what am I invested in? And is this right for me? And the reason I say that is because you might find that as your needs change, as your plans change, with respect to your career, with respect to retirement, with respect to your family, you might decide that you need a different mix. And that would be the time to make those changes. One last thing I'll say about this. This is an area where investment advisors can be especially useful, where you can say to somebody, I've got this balance, I've been working on putting it away, it was in a set of investments that made a lot of sense to me when I made those decisions 10 years ago, 15 years ago. I'm wondering, do they still make sense for me today? And if so, why? And if not, why not? I think those are very, very healthy questions to ask, and I think you should. But if it turns out that being invested in our markets over the long run, mostly in the kind of easy to understand, straightforward indexes or other types of products that have assured millions of Americans retirements for years, I think that's an okay thing, as long as you feel that you have a good grasp of why you're doing it and checking in on that status every once in a while.
Yep. I would also just say, check your fees. Just make sure your fees make sense, because you get feed, on a regular basis. But thank you very much. We got time for maybe two more. Right here, sir.
Yes, Lee Baker, president of AARP for the state of Georgia. Could you explain to us how the regulation best interest differs from suitability regulations for brokers under current federal rules?
Okay, let me give the question. The question is, we're proposing to raise the level of obligation required of a broker-dealer when they're making a recommendation. And the question here is it different from what they have today? The short answer is yes. Let me give you an example. In suitability, if you come up with two investments that are suitable for your client, this is the standard today, there are people who will argue that you are allowed to look at which investment makes you, the broker, more money, and put the client into that investment. This is just an example. Under our new standard, you will not be allowed to do that. You cannot put your interests ahead of your client's interests. We're going to add to that. This is a proposal. Let me be clear. We all have views. We want your views. You guys sent us a letter yesterday. Thank you. No, we want it. Bring it in. Bring it in. We are going to require policies and procedures so that the exercise the broker-dealer goes through to get to that place where they're going to make a recommendation also reflects a duty of care that is enhanced. Okay? I got one more. Thank you. I don't know. How can I decide? I'm going to go right in the middle, right there.
We're attempting to do a security offering that's compliant, say Reg E or Reg S or both. Mm-hmm. It's an incredibly complicated and expensive process. Is there any effort to maybe simplify that?
Another short answer? Yes. No, I'm happy for others to weigh in. We are looking at our private placement rules. They can use a sprucing up. Now, let me be clear about a commission and a government agency. We have limited resources. We have to prioritize what we do, but I think we all recognize that the private placement space can benefit from technology without adversely affecting investor protection. So we have to wrap it up there to stay on time, but I want to give my colleagues, just, if anybody wants to have a last comment. Certainly. Terrific.
All right, we'll try that again. We've had some microphone issues earlier today as well. Good afternoon. My name is Aaron Lipson. I'm the head of enforcement for the SEC's Atlanta office. It's been a very rare opportunity today. We've been privileged to have each of the 5 commissioners from the SEC provide some of their insights and guidance into many of the key issues that each of us face in our individual lives. And for that, I want to thank the commissioners for their participation today. But there's also a lot more that has gone into making at least the first half of today successful. To that end, I want to again thank our hosts at Georgia State University's College of Law, specifically Director of Events Nick Foman, Professor Nicole Iannarone, who heads GSU's Investor Advocacy Clinic that we heard about, and Dean Wendy Hensel as well. I'd also like to thank the numerous volunteers from GSU and the SEC who helped make today happen. I also want to thank many of the federal and state law enforcement and regulatory agencies present today, including U.S. Attorney's Office staff from the Middle District of Alabama, Northern District of Georgia, members from the FBI, FINRA, the Georgia's office, Georgia Secretary of State's office, the Alabama Securities Commission, the North Carolina Securities Commission. When it comes to investor protection as well as capital formation, without interagency cooperation, we don't get very far. And so it is critical for continued success in all of these areas, again, from protection to growing people's personal investments, to looking forward to broader capital formation. Continued working together equals continued success. Most importantly, though, the thank you I want to bring up with true specificity is I want to thank all of you for your attendance here today. As much as we are working to provide you with information today at this initial program and then the breakouts that are going to follow, it's you being willing to come here to provide your time, your feedback, your insight into your investment experiences, your capital formation questions. It's those experiences that you face as participants in the U.S. financial markets that are what's going to make this town hall important, and it's going to make it successful. And so from us, we thank you today. And as I indicated, we are far from finished. There are 5 unique breakout sessions, each one of which will be led by one of the commissioners, and hopefully will provide significantly more time for those questions that you had that we weren't able to get to. The sessions will include Tips for Savers, led by Commissioner Pivovar, Stopping Fraud, led by Chair Clayton, Investing in and Raising Money by Small Companies, led by Commissioner Peirce, Does the information you receive from mutual funds and ETFs work for you, led by Commissioner Jackson. And it did sound like we had a couple of questions in the digital asset space, cryptos, ICOs. That'll be led by Commissioner Stein. There is information and signage in the main lobby area to get you to your preferred breakout session. But to recap, Tips for Savers with Commissioner Pivovar will be in room 347. Stopping Fraud with Chairman Clayton will be in room 342. Small Company Capital Formation with Commissioner Peirce will be in room 242. And Mutual Fund and ETF Information with Commissioner Jackson will be in room 246. And Digital Assets with Commissioner Stein will remain in the large room. So again, thank you for your time today. We hope you enjoy the rest of the program.